Hi, welcome to this video. This month I thought I'll do something slightly different and I'll take you through some of the lessons that I've learned over the last 20, 23 years that I've been investing, and also try and talk about how my investment philosophy has evolved over this period. So I hope you like it. I've also actually written a blog. This came out on Money Control like this week itself. So I'll also link that in this video in case you've not read it. So I try and go a little bit more into detail in each of the points in this uh, video than I had put in the blog. So hopefully it'll be more meaningful. So first of all, I started when just before the dot com crash happened. So year 2000, I just had got my job. Uh, made I had about around 5,000 rupees to invest, and that was also the time when all these online brokerages were coming up. So I used to walk back from my office, and I used to see this ad on these light posts. So went ahead and opened an account, and I had no idea. I mean, I had no idea about investing. I had no idea about terminologies. Did not even know what EPS meant. I had very vague ideas of what sales revenue meant and things like that. So what prompted me to get into investing was I had read Rich Dad Poor Dad, and I could definitely figure out that the way for a common middle class person in was to get into some form of business or investing. And since I was like pretty young, had no capital, no contacts, and everybody in our family are professionals. So the only option that I could think of was to get into the stock market as an investor, so that which has very low entry barriers. Even today that is true. You don't need anything. Just you need to open a brokerage account, and you can get started. So without any knowledge, what I started doing was I started reading Economic Times and Business Standard. And at that time, I remember, I think Business World was the cheapest business magazine. I think it used to come for 5 rupees. If I remember correctly, it was either, there was a time when it was for 5 rupees. Either it was five or, maybe 10 rupees. I don't exactly remember. But that was I also subscribed to Business World, so that initially it was very difficult for me to understand the terminology, what is happening. But like I keep saying, knowledge is the highest compounder, right? If you keep doing something, if you keep reading and keep augmenting your knowledge, that tends to give the highest compounding. So obviously I started picking up things, and I still remember there I used to cut out paper cuttings uh, from the newspaper, from Economic Times, from Business Standard, and I used to have a file. I had that file at my home till a few years back. uh, Basic, where there were some articles explaining the basics, explaining personal finance and those kinds of things. So completely started from scratch. There were two websites. Both of them are in existence even today, though they've changed their nature slightly. One was in investopedia.com. It's still pretty good, and the other was fool.com. So Fool has probably now migrated more towards being an advisory in the US. But at that time, they used to write extremely good content for beginners. There were tutorials. So I used to sit and go through all of those tutorials every evening. Saturday, Sunday, nearly 12, 13, 14 hours a day. I used to just keep reading. And obviously, when you start reading as an investor, some of the first books that people tell you to read was Buffett's Warren Buffett's books. And so I started, and it completely gelled with me initially. And so I started my journey, trying to sort of uh, emulate what Warren Buffett did. So I think everybody, when they start, at some point at the back of their mind, they think of becoming the next Warren Buffett. Uh, so you start imbibing some of the strategies, the theories that you keep learning. So I read Peter Lynch, I read Warren Buffett, I read Phil Fisher, all the standard books that people talk about. Also remember that this time YouTube was not very prevalent. I don't even remember if YouTube was there in 2000. I don't think so. But there were not too many avenues to learn other than books and a few of these websites. The other very great thing that happened to people like us was there used to be a Tuesday 4 o'clock chat with Ramesh Damani. He used to come on live and painstakingly answer questions from all novices like us. And when I met Ramesh ji, this was something I just told him that you know for people like us, you cannot even imagine what kind of a boon it was, because here was a very very a great investor, a legendary investor who was taking time out to explain to newbies about investing, about what is the right mindset to get into, what are the things to learn, how to look at businesses, and those kinds of things. So that is how it started, and it kept going. And I, by nature, am a slightly reflective person. So whatever I do, I try to reflect back, whether it is good, bad, whatever. And there's some sort of a control system in my that works in my mind. So continuous feedback loop. So something good or bad happens, I try to take the lessons from that and feed it back into my process. So I've always tried to improve the process, look at what is around me, what is happening in the practical world, and then try to map it to what I know and how to improve things. So over the years, what I started realizing was that Indian markets were not exactly what I read from or what I read about in the books that came from the US. A lot of things did not make sense to me. Here, I found that there were a lot of stocks where there was very high P, and that P sustained for a very long period of time. So those were anomalies to what I could hear or what I could see from from what I read in the books. The other thing that I could see was, even if you buy a great company, it does not necessarily mean that it will give you great returns. One of my first investments, in fact, my first investment was Hindustan Lever. This was 2000. I paid roughly around 180 or 183 rupees, if I remember correctly. And 10 years later, I sold that stock and I roughly sold it at the same level. So 10 years. And in fact, it was waiting for me to, sell it probably. And right after I sold it, it sort of went into another orbit and did really well. But the point I'm trying to make is 10 years is not a small time frame, right? It's a very long time. And for a stock to not perform, and for as one of the best businesses in the country. So these were small anomalies that I kept looking at. Also, I found that stocks, and here I'm not talking about businesses, but this is also true of businesses. They don't Very few stocks will do well continuously, right, for years on end. Mostly what I have seen is stocks tend to do well in bursts, right? So there'll be a between a 6 month to a 2 3 year time horizon where uh, a stock will do well, then it will go into a consolidation mode for again maybe a couple of years or whatever, and then again if the business continues to do well, the stock will do well. So over a longer period, last few years, I started exploring other avenues. So I started looking at quant. Now I started looking at momentum, quant, and these factors before people in India mostly had heard of it. And one of the reasons, and in India practically most people started looking at quant after reading about Jim Simons when his biography came out. But I actually chanced upon another book where there was this list of great investors and traders over the last 30 years, and their long-term CAGR was given. And what astounded me was, Warren Buffett, who I sort of thought was the greatest guru of all, was somewhere at the lower half, middle of lower half of the list of people who had very high returns over long periods of time. So I started questioning that, okay, if this is true, I mean, and ultimately we are all coming to the markets for getting returns, right? So I started questioning, that, okay, if this information is correct, and by this time I had read all the market wizards books, and mostly I knew about all those investors and traders, and I then started wondering, if this is true, and this is, then what is it that enables these other guys to and this group was practically 100% male, so that's why I'm saying guys. But what is it that made this set of people generate these extraordinary returns? Some people had more than 40, 50, 60% CAGR over 15, 20 years. Now, even if you look at, say, our Rakesh Jhunjhunwala, phenomenal returns over a 20, 30-year period. uh, so I started then understanding that lot of things matter, that the typical book, textbooks of investing don't tell you. So I went into an exploration. So I chanced upon quants, I chanced upon technicals, technofunda. So all of those things came out of introspection and reflection on how markets actually work. So now I have probably come to a stage where I'm trying to merge all that I keep learning into my style or my philosophy, whatever you call that. So what I will do is I'll try to go through some of these points one by one. So first of all, like I said, what I've realized is stocks are not forever, no matter who says what. Ultimately, you are in the business of making money when you are an investor, and you have to first of all determine your time horizon. If you are a long term investor, define long term. What long term means to you? Is it 5 years, 10 years, 15 years, 20 years, 30 years, 50 years, 100 years, right? When you say 100 years, you are looking at intergenerational wealth creation. So I work with some family offices also, and their approach is very different. They are looking at intergenerational wealth creation, and then you are looking at more than 50, 60, or maybe 100 years time horizon. Even with that, you have to be very clear that stocks or businesses don't do well continuously over decades, right? So that's the first lesson that I realized, that you have to be always on your toes, looking for great businesses, good businesses, which you can own for a time. And the next point is very similar to that, is I want to hold on to a business as a long term investor, as long as that company or that business is doing well. So in a way, I'm a fair weather friend of a company. If the company is not doing well, I'm not interested to being a party or a partner to that, right? Because I have 5,000 choices on the National Stock Exchange or the Bombay Stock Exchange, and it's not that my parents or grandparents or somebody has gifted me those companies, and I'm not the promoter of the company, so that I need to hold on to it. So the point is that as long as a business does well, so for example, if Bajaj Finance is done well for 10 years, I might hold on to it for 10 years. If there is a company which does well for 2 years, 3 years, I will hold on to it for 2 3 years, and then I will keep looking for the next good company that will do better for the subsequent 2 3 years. The third point that I realized is, because I was a salaried employee, capital and practically no inherited wealth. So you, whatever you have is what you have, right? Whatever you earn, whatever you save is what you have. So the most important part was to not lose capital uh, permanently, right? So you don't want to go and invest in companies which have questionable business practices, have questionable corporate governance, where you don't understand the business. So you don't want to do all of those things. That I think is par for the course. Now, what additional things I did was I could realize that no matter how much you study the company, no matter how much you talk to the management, no matter how much channel checks you do, you will never know 100% about a company. No one does, right? If that was true, all these great investors, they would have 100% win rates. That does not happen, right? Warren Buffett also has bought IBM and sold off at a loss. So the point is that nobody will be 100% correct. So how then do I protect myself? The way I thought of in the simple way is, if I am not sure and the price action is going against me, I will use stop losses and get out. I will at least protect my capital. I can always get back in, right? I mean, in India today, if roughly getting in and out of a position will take you between 0.5 to 1%, right, of brokerage and tax and STT. I mean, not tax, but brokerage and STT put together, buy and sell. So uh, risking 1%, uh, or you're saving or trying to protect 1% and taking bigger losses. To me, that does not make sense. So what I always decided was, it is very important to have the self discipline, at least when you are protecting your capital. So that has to be paramount, because we have money which is limited, and that money is it's not going to come back. It will not replenish itself. So very, very important is not to lose it for me. Then the next thing I realized is we need to have multiple strategies, right? So what we've seen over the last, say, 10, 15 years, 20 years, is even investment style is cyclical, right? So sometimes momentum does well, sometimes value does well, sometimes GARP does well, sometimes quality does well. And you will see that sometimes there is a preponderance towards small caps and mid caps. Sometimes large caps will do well. The point is, if you get tagged, and this is what typically happens with 99% of investors, is they get tagged as a particular style investor. So you have XYZ fund manager who is a quality, or buy at any price. You have somebody else who's a momentum guy, somebody else who's a growth person, somebody else is value, whatever, right? So, and then once you get boxed into that tagging, it becomes very, very difficult to get out of it. So I consciously started thinking in terms of strategies. So at any point in time, my portfolio, this is what I've been thinking in, and trying to implement, is my portfolio should have multiple styles. It should have large cap, mid cap, small cap, value, growth, whatever style is there. And then you sort of pick up the style based on what the market trend is telling you. So if so trend following is again a very, very dominant style, right? And if you see around you in life, trend following is something which is very, very prevalent in every walk of life, right? So if you look at, say, the OTT movies or serials that are coming out today, there is a trend, right? You will find all thrillers and spy stories and those typical genres which are coming out. Why? Because one or two of those kinds of movies have done well, or series have done well, so everybody now wants to pile on to that. It is the same way in investing, right? It is ultimately human psychology. So if something does well, it will tend to do well for some time, till an inflection point comes across, and then you will need to switch your style. So I consciously now look for multiple strategies, and try to switch between strategies as and when the trend keeps changing. So that is something which I found to be extremely useful. The next thing is momentum. So this is something that I started looking at very seriously about 5 years back. And what I found is that, although momentum, by momentum, nearly everybody understands the thing as price momentum. Stock bhag raha hai, to that is momentum. But there was this one VP session where in Goa, Professor Sanjay Bakshi was one of our guest speakers, and he gave us a very interesting thought. He said, think also in terms of business momentum. And I immediately understood what he was saying, because inherently that is what kind of businesses I like, which typically end up becoming compounders. So Bajaj Finance or HDFC in the in the first 20-25 years of its existence, these were companies which were doing extremely well in terms of their business. So the business had momentum, and typically the biggest money, or quote unquote the multi-baggers, are made when you have business momentum, and which is sort of followed by price momentum. So business does well, the price continues to do well, and over a period of time you get a multi-bagger. So very very important to look at business and price momentum. Then this is the next point which I have sort of now sort of understood and imbibed. Ultimately it is bhav bhagwan hai. Price is the final adjudicator. There are a lot of debates, right? Is value good, is growth better, is this that or whatever, right? Ultimately we everybody is investing to make money. How do we make money? We make money if you buy something at 100 and you sell it at greater than 100. You sell it at 120, 150, 200, whatever. So ultimately it is the price which matters, right? I'm sort of ignoring dividends here in this case, because roughly in India at the market level you will have dividend yield is roughly between 0.5 to 1% at an aggregate level. So it's not going to make a huge difference unless you are a dividend investor, or a dividend growing dividends kind of investor. So ultimately price is the final adjudicator. Whether you are right or wrong is determined by the price of the stocks that you have in your portfolio, right? So you buy a great company and the stock price does not agree with you for 5 years, 10 years, then you are wrong, right? I mean, it's as simple as that. So there that is how I sort of gel technicals or quant into my fundamental investing, because ultimately it is important to focus some part of your analysis on how price is going to behave. The next thing I realized over last few years, maybe the last decade, is value is in the eye of the beholder. Now everybody talks about you know PE, or valuations, etc., etc. What I quickly realized initially was that it is a very very subjective exercise. You get 10 investors in one room and give them the same data about a company and ask them to do a valuation exercise. Most likely you will get 10 different valuations coming out of them. So if that is the case, how do you value a company, right? uh, I will not get into how to value a company. There are multiple methods, but what I try to do is to keep things simple. I try to understand the business story, the narrative of the business, and I try to, have a very reasonable. I mean, not I will not try to get to the last penny, but I'll try to get an understanding of how much it is likely to grow. Is margins going to improve? Uh, is there going to be more dilution in the company, and what is going to be the likely P if the company is able to grow at these levels, at this particular ROE levels, etc. So a very very rough back of the envelope kind of calculation is what I personally do. Now uh, the other thing what I've learned is that valuations can persist at very high levels for very long periods of time, and people who buy or sell on valuations, most of it in the Indian market context, if you're relying solely on valuations, you are leaving a lot of things on the table, right? And going back to first principles, my objective here is to have decent returns over a long period of time. So I don't want to leave a lot of things on the table. So again, the other factor about valuations is there are two components to valuations. Again, I've written a lot about it previously, and maybe I'll look up those articles and share it also in the notes. But valuation has two components to it. One is the number that you come up with when you do your intrinsic value calculation, and the other is the transaction value. So what it means is, for example, just to give you an example, say a painting, a Mona Lisa, right? A Mona Lisa has no intrinsic value because there's no cash flow. You cannot say that a Mona Lisa is worth $1 million or $10 million or $1 billion. because it's not giving you any cash flows for you to do a DCF kind of exercise. But does it mean that a Mona Lisa does not have any value? It does not, right? So what is the value? The way to value anything is, one is its cash flow based valuation, which is what we do in intrinsic value calculations, and the other is based on transaction valuation. So what is the other guy, what is somebody else willing to pay for it? And that depends on demand and supply, right? So uh, so art, gold, uh, all of these, Bitcoin, etc., these have no intrinsic value, right? uh, the entire value that they get is because of the transaction valuation, what somebody else is willing to pay for it. And in the markets, if you think about it, this also plays out. At times markets get overvalued, which means that demand at an aggregate is much more than supply, and hence we see an overvaluation of everything. And at times when bull market ends and when you are in a bear market, you have demand collapses, supply is much more, so that people are not willing to pay as much, and therefore you have low transaction values and your overall valuation goes down. So the point I'm trying to make is that a lot of value is subjective, right? So don't just look at Excel based valuation models and get into a business, right? You need to factor in a lot of subjective information to get your valuation roughly right. That's been my experience. The next factor again is very very important. There are two warring camps that I have seen. One is the fundamental guys, the other is the technical guys, and both these sides tend to belittle the other, saying that fundamental wale, the technical guys say that fundamental guys know nothing, and the technical and the fundamental guys say that exactly the same about the other camp. Now, what the way I have sort of reconciled these two is, one, all of it is information. When you're looking at fundamentals, you're looking at the business economics, you're looking at the overall economy, you're looking at the industry data, all of that, right? And when you're looking at technicals, you're looking essentially at the demand and supply of that particular stock, or of the overall marketplace, uh, at an aggregate level, right? So that is what you're looking at when you're looking at technicals. So to me, both of these streams are information sources, and saying that one form of information is superior to the other form of information, to me is just plain and simple stupid, right? So both these forms of information is there for you to use. uh, Whether you can use it or not is up to you, right? But it is there to be used, and there are people who are able to use it. And if you are able to use it, if you're able to correlate both these information, then the better for you. uh, the next point is about diversifying across time frames. So this is again, I used to be, like I said, initially when I started my investing, I used to be the Buffett-esque kind of investor, buy and hold, and I used to be very proud about it. I never had, I never sold a stock before it was like 1, 2, 3 years of holding. So the whole idea was to uh, buy and hold companies for over a very long period of time. What I realized was that while doing that, automatically I am eliminating a lot of companies, a lot of businesses which are by nature, you know, shorter term in nature. So you might have special situations, you might have cyclicals which do very well for short periods of time, for maybe 3 months, 6 months, a year. And I was leaving them on the table because I was mentally not pursuing those. So when I started doing my quant stuff, what I realized was that here is one avenue which I can use to actually pick out uh, opportunities which are of a shorter time frame. And that is how I started delving deeper into quant based systems, into technofunda, etc. But the point here is to be able to capture opportunities across time frames and have positions in your portfolio across time frames. So if you are a very long term investor, it doesn't mean that you will completely shun cyclicals which may do well for a year, right? So uh, so that is something that I have also learned and imbibed in my process. And the last thing that I've, what I've realized over the last 15-20 years, and very very critical to what I do currently, is that the ultimate differentiator between investors is psychology. Now you will find two investors buying the same stock at the same time at the same price, and yet come out with completely different results based on their own personal psychology, based on their ability to hold on, their ability to sit through drawdowns, or their ability to book profits or losses, right? Uh, the other aspect when I talk about psychology is what I found, especially with retail investors, is the inability of digesting big money, right? Big gains. Most people get very very jittery if they start seeing 40-50% returns. The point that most a lot of them miss is, if you are making 50%, or your road to a 10 bagger will start with a 50%, 100%, 200, 300, 500, whatever, right? That is the route. You cannot get to a 10 bagger uh, if you sell with a 20% profit. And most retail investors I've found is they get very jittery, uh, and they want to book profits early, and they are very reluctant to book losses, right? Their inherent thought is that uh, this will come back to my price and then I will sell it. I don't want to book losses. So these kinds of psychological impediments or psychological biases, in my opinion, is 70-80% of investment success or failure. So if there is one thing that as an individual investor you want to work on, I would say, is to work on your psychology first. The skill part of it, right? The analyzing the business, the balance sheets, etc., etc. Those are par for the course. Everybody is able to do that, right? What differentiates a great investor from a average or a poor investor is mostly about psychology. With that, I'll come to an end today. I hope you found today's session interesting, and whatever your thoughts or feelings, do let me know. Put in your comments or send me a mail, and we'll take it from there. Thanks.